Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Pekko and my partner, Hari.
Morning.
Good morning, everybody. We're going to talk about price to book and special situations today in this episode 30. In the last episode and a couple previous episodes before, we talked about price to earnings and price to free cash flow. Excuse me. As we said in those two episodes, these valuation ratios we covered in an episode called Valuation Ratios. But we want to take this opportunity to delve deeper into some valuation ratios in a more detail. So in this episode, we're going to talk about price to book, sum of parts, and price to cash. And we will tell you how these valuation ratios are relevant in some situations. And so let's dive into it right away. So what is price to book? Hari, let's start with the definition of price to book, and then we can move on to the other valuation ratios.
Yeah, so typically there is, book value is considered the, the equity in the company. Those two terms are synonymous, and that, is the assets minus liability, right? So when you look at that, you're now comparing it to a price, right? So you can do that with market cap. So market cap divided by equity will give you the same ratio as the current stock price divided by book or equity per share, right? So you can just take the equity of the company and divide it by the number of shares outstanding, and then you get the same number. And what that's really telling you is that if I were to give you all of the assets of the company, how much would you pay for that? And if that number is below 1, what you're essentially saying is that I'm getting more assets than I'm paying for. So price to book really, I think, is like a, there are a lot of companies that are, especially now that we live in a tech heavy world, that don't have a lot of assets, don't have a lot of, but traditionally that's how you kind of looked at that stuff,
right,
with assets, liabilities.
Right.
Where you see that important nowadays is like financial type companies.
Yeah,
so
like
banks, insurance companies are heavy into the price to book ratio. So to give you a personal example, there was a company in the early 2000s called Pacific Care Health Systems. They were a health insurer based in California, and so at the time, like United Healthcare and other companies were were regional. They weren't national. So I looked at this company. They were trading at around $6 a share, and their price their book value was about $30 a share. So this had happened after some California regulation had changed and crushed the stock. So the book value of that was the $6 divided by 30, which was 0.2, which is quite low, right? You're not going to find that very often, and especially for an insurer. Well, so interestingly enough, I bought shares in that, and United Healthcare came in and bought. The stock stayed there for a while, and then it, after about 6 months or a year, it may have been longer than that. United Healthcare came and bought the company for $60 a share. So, why that is important is you don't see that very often, but when you do find a price to book that is well below 1, it's worth at least looking at.
Yeah.
Right. And for some companies, it's useful. Right. But not all of them.
Yeah. Yeah. If it's that low, it's like the margin of safety is really baked in, depending on the industry.
Right.
But
that's
it's a larger margin of safety when you get down to the ratio that's so low like that.
Yeah. Well, and I think one of the things that's interesting about that specifically is, when you start taking away components of this, that's actually how Ben Graham early on was doing investing. He was using price to book, but a modified form of that. He was actually taking away the non-current assets, and he was just doing current assets minus total liabilities, and he was calculating a value there. And the idea was that current assets could be converted to cash within 1 year, and if you could pay off the entire debt of the company, you could shut down the business, take the cash out of the business, and profit. And so that was actually how Warren Buffett did a lot of his early investing was looking at these situations where they were trading at more than their current assets minus total liabilities.
Yeah.
And so that's another form of quote unquote book value investing, where you're looking at some of these old, terrible businesses that have, that are declining. And sometimes, and nobody likes to think of it this way, but sometimes shutting down the business and just returning the capital to shareholders is actually better for the long-term outcome. Because there is no future for that business, right?
Exactly.
It's just getting outsourced or replaced, or by technology or manufacturing, so or automation rather. So those kind of things are what you have to start thinking about sometimes in these cases.
Yeah. Exactly. So price to book, again, price to book value is synonymous with equity. Equity we covered in the balance sheet episode. Take a look at that if equity doesn't ring a bell. Equity is something you can calculate, something you can find in balance sheet.
Yep.
So have a look at that if you are not following what we're talking about here. Okay, so let's move on to the second kind of measurement of second way to look at price to book, and that is sum of parts. And this is important in some very special situations when it comes to valuation. So would you like to tell us about that, Ari?
Yeah. So usually businesses are operate in one single industry or one single focus. And so, you can't do a sum of the parts, because the sum of the parts is usually taking disparate parts and, the cash balance, maybe taking out the debt of the company and then valuing it based on that compared to the current share price. So let's say you have a business that has, our hot dog business also has a burger chain, right? So in that case, let's say that burger chain is actually something that we've bought 30% of. Right, or 50% of. So what you could theoretically do is say, what is the value of, and these things are known, what income is for the hot dog chain, what income is for the burger chain. You can actually value those two companies independently and sum them together. And the idea is that because Hot Dog Inc. owns Burger Inc., Hot Dog Inc. is, it may be undervalued for, because of, things look ugly. Maybe they had a bad quarter, or, earnings didn't come out the way they wanted to, but Hamburger Inc. is doing great. Burger Inc. is doing fantastic and is making money, but everybody's focused on the core parts of Hot Dog Inc. So, I would say this situation is actually not that uncommon. I mean, you see it a lot, that the way Wall Street really focuses on an earnings is that they focus on the current business of the company, and they don't really pay attention to what other things that the company owns. And so especially when you start getting into like conglomerates like Berkshire Hathaway and things like that, they have hundreds of businesses that are each individually maybe worth a lot more when you add it together than what Berkshire Hathaway is trading for. And so what you should focus on when you see a company like this is, look at the assets that you can easily value, right? And those are cash, because cash is cash. And then look at, like, they may own, securities in, third-party companies. They may own, a whole business. So if you own more than 50% of the business, you can actually take the earnings of that business and put it into your own, that's consolidation of your earnings. So, one of the things that's very interesting when you start doing that is, when you sum up a lot of these businesses, you can see that it's cheap, and it's not a be all end all final valuation, right? But it's still a very good way of measuring things.
Yeah. So the discrepancy. So the fundamental idea behind sum of parts is that the sum of individual parts, if you value it individually, some of that is higher than the current price of the entirety of things. So that the discrepancy is what you're looking for. And if there's enough discrepancy, it might be worth taking a further look at this.
Yeah, and this is not unlike what we just talked about with Ben Graham, where you sell off all the assets, pay off the liabilities, and you have a company. You could theoretically do the same thing. Buy the company, sell the individual parts of the business, and you would get less, or you would be paying less than what you could if you sold them individually on the market. So what you're seeing in this whole lecture or this whole episode is really just, what can I do what is the market pricing these things for, and what could I sell them if I sold them all off by themselves, right?
Like a liquidation price.
Yeah, it's a liquidation price for everything.
Yeah. So that's a sum of parts. Let's move on to the third measurement, which is price to cash. I think this is really interesting.
Yeah.
Warren Buffett used this measurement, and we analyzed a few companies with this sort of measurement, price to cash, and some of the companies we analyzed fell into this category, fell into this value category when we measure it to price to cash. So tell us about that, because I think this is really, really interesting stuff here.
Yeah, so think about it this way. When you have a company, let's say that they're trading for they have $50 million market cap, right? Or actually, I'll use a real example. The company that had $88 million in cash on the balance sheet, and they had no debt, no long-term debt to speak of. The entire business was selling for $100 million in the stock market, right? So price to cash was very close to 1, and the business itself was profitable, right? So there was very little risk that the company was going to go out of business.
Yeah.
And so what you see is that if a company has more cash on the balance sheet than it's currently trading for, you could theoretically buy the company for less than its current market price, or then you could buy it with the market price being less than the current cash available to you if you control the business.
Yeah.
Right? So you could essentially take a 50% control of the business and then distribute all of that money in cash to the shareholders.
Yep.
And so when you see that, I mean, it's almost like there is no lower floor than that, right? You're at the basement at that point, because there is no... I mean, there is definitely a risk that companies could trade for less than their cash on their balance sheet, right?
Yeah.
And that happens not very often, but sometimes.
Yeah.
And when it does, it's a 30, 40%, 50% bump.
Upside, yeah.
Is easy to achieve because there's no real bottom.
Yeah. The spring is so compressed at that point. There's no other. There's no more room for the spring to be compressed.
Yeah.
And I think I want to point out a couple of things. So I think price to cash, if it's less than 1, or if it's less than 1. So in other words, the company has more cash on their balance sheet than the price it's trading for. If that is the case, I think a good example that one of our mutual friend Frem mentioned, I think the analogy is quite apt, which is, let's say you go and buy a used car for $500. And you bought it for $500, and it turns out that in the glove box, in the glove compartment, there's $1,000 right there.
Yep.
So you're getting another $500 for free.
Right.
And so there's really, the floor is baked into this if price to cash is above or below 1.
Yeah. Now there's a couple of caveats. Obviously, it's nice to see that the price to cash is there, but if the company also has a ton of debt, then what you should be thinking about is not what's called market cap, but enterprise value, which is the current market cap plus the debt. Because then that can tell you the reason that they may be so cheap is that they're about to go into bankruptcy, right? So just be mindful of, it's not purely the cash and the and the market cap. It's the what is the debt level too.
Yeah. You could also do it price to cash minus all the debt.
Correct. I mean, this is the same concept.
Same concept. Yeah.
Yeah. I think the idea though is to make sure that you are well above the the ability to, because the worst thing that can happen is they liquidate the business, but you get nothing because you're lowest on the totem pole on the bankruptcy side of things.
Also, another thing that I want to point out is this is kind of the classic value investing.
Yeah.
Championed by Warren Buffett, championed by Benjamin Graham.
Yep.
And value investing sort of morphed into something that we know, different flavors of value investing, but I think originally started as something like this, investment thesis, investment process where you find a company that's trading below cash.
Right.
And just picking them up and waiting for it to mature into the right value.
Yeah, and what I would say is, the best way to find businesses like this is to start using a stock screener, because that can help you identify them. But you still got to do your homework. Don't, and what you'll typically find is there may be 3 or 4 companies that even meet this criteria at any given time.
Yeah.
And most of those companies don't even, their debt is too high, or they have some other weird, issue going on. So to be mindful of that when you start looking for these. What I will say though is the track record for them is pretty spectacular. So if that's your sole focus and you find these deals, Warren Buffett, was commented as saying in his early career he made about a 50% annualized return.
Yeah, that's crazy.
Using this and similar methods, everything that we've talked about in this episode, the current assets minus total liabilities, which is the Graham method, or what he called net nets. There is, the price to cash, sum of parts. All of these things are essentially looking for the same thing. Can I get $1 for 50 cents?
Yeah. Yeah. So there it is, guys. Price to cash, sum of parts, and price to book. These are pretty useful measurements as another entry point into your valuation. Anything else you want to add here, Hart, before we move on to the next episode?
Yeah, I think just the only thing I would say is if this concept is difficult for you to understand, we will probably be using this, one of these 3 or all of these 3, when we start talking about individual stocks next month. So if you are curious as to how you would apply some of these things, or something didn't make sense, I think the best way to learn is to do a real world example with us, and we'll start doing that next month. Yeah, that sounds great. Okay, that is it for us in this episode 30. We will see you on next episode 31. Thank you, guys. Thanks.